America isn't bracing for the next recession anymore. It's already moving through it, quietly, unevenly, and without the drama people expect. While officials repeat that growth is holding and fundamentals are strong, everyday life tells a different story. Credit balances are rising. Payments are getting heavier. Jobs feel less secure even when unemployment looks stable. This disconnect isn't accidental. It's how downturns actually begin. Recessions don't arrive with sirens. They arrive with hesitation. Buyers pause. Businesses delay hiring. Households stretch decisions just a little longer. On paper, the system still looks intact. On the ground, the pressure is already building. That's why this moment feels confusing. People are waiting for confirmation, but confirmation always comes late. What's happening now isn't a single national collapse. It's fragmentation. Economic stress doesn't spread evenly across 50 states. It concentrates. It finds weak structures. First, states with heavy debt, fragile housing math, pension strain, or over-reliance on one industry feel it earlier. Others follow later. By the time the averages turn red, the damage is already done in specific places. This is where the story breaks from official optimism. A state can report growth while households lose breathing room. It can show strong employment while insurance, taxes, and interest rates quietly erase flexibility. Collapse doesn't require panic. It only requires the math to stop working for enough people at the same time. That's why this video isn't about fear. It's about clarity. When you understand how downturns actually unfold, you stop waiting for headlines to tell you what's already happening. You start watching behavior instead. Migration patterns, housing stress, budget strain. Those signals speak earlier than press releases ever will. Some states are already cracking, not loudly, not dramatically, but structurally. Their safety margins are thinning. Their options are narrowing. And once those margins disappear, adjustment becomes unavoidable. If you felt that the economic story no longer matches your lived experience, you're not imagining it. You're noticing the shift before it becomes obvious. Stay with me, because what comes next isn't speculation. It's pattern recognition, state by state, showing how downturns really begin. This awareness isn't about predicting dates or calling bottoms. It's about reading stress before it becomes visible. When you learn to see early, you gain time, choice, and leverage while others are still debating whether anything is wrong yet today. Subscribe and hit the bell. This shift is already unfolding. Collapses don't happen everywhere at once, and they never happen randomly. They follow pressure, and pressure follows structure. Once you understand that, the economy stops feeling chaotic and starts looking legible. You stop asking why some states fail early and start asking which systems were fragile to begin with. The first stress point is housing affordability. When home prices outrun local wages for years, the market doesn't become strong, it becomes dependent. Dependent on low rates, constant migration, and uninterrupted optimism. The moment borrowing costs rise or incomes stall, demand doesn't slow gradually, it disappears. States with the widest affordability gaps feel this first because there's no cushion left. Next comes pension liability. Public retirement promises don't shrink during downturns. They grow heavier. States that deferred funding during good years enter recessions already wounded. Every budget dollar sent to pensions is a dollar not spent stabilizing services or lowering taxes. When revenues fall, these obligations don't bend. They force cuts, borrowing, or both, accelerating decline quietly but relentlessly. Federal dependency is another fault line. States that rely heavily on federal payrolls, contracts, or transfers appear stable until Washington tightens spending. Then entire local economies wobble at once. Job losses compound. Tax revenue drops. Budget gaps widen fast. This isn't politics, it's exposure. Concentrated dependence always magnifies downturns. Industry concentration works the same way. States tied tightly to oil, tech, tourism, or finance rise faster during booms and fall harder during slowdowns. Diversification dampens shocks. Concentration amplifies them. When a dominant sector pauses, everything linked to it stalls, from housing to retail to local government budgets. Population flight is the behavioral signal most people ignore. People don't leave at the first sign of trouble. They leave when costs rise faster than opportunity. When outflow replaces inflow, housing oversupply forms quietly. Prices soften. Services strain. The tax base thins. Reversing that momentum takes years, not quarters. Finally, insurance exposure turns abstract risk into monthly reality. Rising premiums act like stealth tax hikes. When coverage becomes unaffordable or unavailable, ownership itself becomes uncertain. Buyers hesitate long before prices fall. Sellers emerge not from fear, but from arithmetic. This is the lens. None of these forces act alone. When several align in one state, outcomes narrow fast. Understanding this doesn't create panic. It removes it. You're no longer reacting to headlines. You're reading systems. That shift matters. It replaces guessing with diagnosis and emotion with structure. As we move through the states ahead, don't watch for drama. Watch for overlap. That's where collapses begin, quietly, predictably, and long before consensus notices. This mindset changes how you interpret news, conversations, and advice. Instead of reacting emotionally, you test claims against structure. You notice when reassurance lacks math and when fear lacks grounding. That calm discernment is power. It lets you wait, plan, and reposition while others argue about narratives that already expired and shape decisions before pressure forces rushed mistakes. Subscribe and hit the bell. Once you see this lens, you can't unsee it. Number 12 is Colorado, and this is where appearances still deceive. From the outside, Colorado looks modern, educated, and prosperous. Tech campuses, mountain tourism, and high incomes create the illusion of resilience. But inside the system, strain is accumulating quietly. Housing costs surged far beyond what local wages can comfortably support, and that gap matters more than optimism. Families don't panic here. They recalculate. They delay buying. They quietly leave metro areas for cheaper states. When hesitation replaces confidence, demand thins without making noise. Add cooling tech hiring and rising commercial vacancies, and the foundation starts to soften long before headlines admit it. Number 11 is Mississippi, where fragility isn't hidden, but it's often misunderstood. This isn't a sudden collapse story. It's an endurance problem finally running out of margin. Low incomes leave households with no buffer against inflation, rising rates, or job loss. Federal support props up budgets, but that dependence becomes dangerous when national spending tightens. Housing stress grows not because prices are high, but because affordability was always razor-thin. Foreclosures rise quietly. Small towns hollow out slowly. What looks like stability is really exhaustion. And once resources thin further, recovery becomes structurally difficult. Number 10 is Maryland, a state long anchored to Washington's gravity. High education levels and strong incomes created confidence that downturns belonged elsewhere. But when an economy leans heavily on federal payrolls and contracts, stability is conditional. Budget delays turn into layoffs. Layoffs turn into housing pressure. Property taxes rise as governments search for revenue, even while households feel squeezed. Maryland's challenge isn't unemployment spikes, it's dependency risk. When one employer dominates, the shock spreads quickly. That's why erosion here feels sudden to residents who believed proximity to power meant protection. Number 9 is Delaware, small enough that pressure concentrates fast. For decades, the state benefited from its role as America's corporate home. That advantage is fading quietly as firms relocate or restructure. Corporate tax revenue weakens. Budget gaps open. Pension obligations don't shrink. Housing looks stable on paper, but debt-to-income ratios climb underneath. When even modest job losses hit, entire counties feel it at once. Delaware doesn't collapse loudly. It compresses. And compressed systems fail faster because there's no room to absorb shock. What unites these four states isn't drama. It's subtle decay. None are in chaos. Schools still open. Roads still function, paychecks still arrive, but confidence is thinning. People pause before buying homes. Businesses slow expansion. Governments delay projects. These are the early fractures most people dismiss because life still feels normal. This is the most dangerous phase of any downturn. When nothing feels urgent, people wait. They assume conditions will normalize, that relief will arrive, that strength will return. But cycles don't reset on patience. They reset on adjustment. And adjustment begins in places where margins were already thin. Across Colorado, Mississippi, Maryland, and Delaware, the same pattern repeats. Housing stress emerges before job losses. Budget strain appears before service cuts. Migration shifts before population collapse. By the time fear arrives, leverage is already gone. That's why these states matter. They teach you what early failure actually looks like. Not sirens, not crashes, but hesitation. The absence of urgency. The quiet realization that yesterday's assumptions no longer work. If you recognize this stage, you gain time. Time to think, plan, and position rather than react. Most people miss it because it feels boring. But boring is where outcomes are decided. Once decline becomes obvious, options shrink fast. Stay with me, because the pressure accelerates from here. Number 8 is Alaska, and here the stress stops pretending to be subtle. Alaska has always depended on oil, and that dependence turns volatility into destiny. When prices soften, revenue evaporates quickly. State reserves drain. Projects stall. People leave. Population loss isn't abstract here. It shows up in empty homes, shuttered businesses, and schools consolidating classrooms. Housing doesn't crash loudly. It stalls as sellers list before leaving, and buyers hesitate to commit to a shrinking economy. Costs stay high while opportunity thins, and that mismatch forces hard exits rather than patient waiting. Number 7 is New Mexico, where vulnerability comes from overlap. Federal dependence and energy reliance once provided stability, but together they now magnify risk. When Washington tightens and energy revenues slip, the budget absorbs the shock immediately. Job growth slows. Public services strain. Housing weakness spreads because wages never had room to stretch. Foreclosures rise not from speculation, but from exhaustion. Families who were barely holding on lose margin, and margin is what keeps downturns survivable. New Mexico doesn't implode. It sags under weight it can no longer carry. Number 6 is Nevada, and this is where visibility replaces denial. Nevada's economy runs on confidence, tourism, and construction, and all three react instantly when uncertainty appears. When visitors pull back, income drops fast. When income drops, housing follows without delay. Inventory surges, foreclosures accelerate, investors exit because numbers no longer work. Las Vegas still shines at night, but daylight reveals vacancy, stalled developments, and households stretched past comfort. Nevada shows what happens when a speculative engine loses fuel. There's no gradual adjustment, only abrupt repricing. Number 5 is Louisiana, where fragility has been normalized for so long it feels invisible. Heavy federal reliance, persistent poverty, and climate exposure create constant pressure, but insurance finally breaks the system. Premiums surge. Insurers leave. Ownership becomes unsustainable even before prices fall. Housing weakens because protection disappears, not because demand vanished. Energy jobs no longer buffer downturns, and infrastructure struggles under deferred maintenance. Communities don't panic here. They adapt downward, accepting less, until decline becomes permanent. What ties these states together is the failure of cushions. Reserves run out, industries contract, migration reverses. When safety nets thin, stress moves quickly from balance sheets to daily life. Optimism lingers because people remember how things used to work. But reality moves first. Revenues fall before layoffs hit headlines. Foreclosures rise before prices visibly drop. Population loss accelerates before anyone calls it a trend. This is the phase where belief finally confronts math. When core industries weaken, No amount of optimism can fill the gap. Alaska's oil, New Mexico's federal flow, Nevada's tourism, Louisiana's insurance system. Each once masked risk. Now each exposes it. These are not random failures. They are predictable outcomes when concentration meets contraction. These environments also change behavior in subtle ways that matter. Employers freeze hiring instead of announcing cuts. Homeowners defer repairs and upgrades, quietly signaling stress. Local governments delay maintenance, pushing costs into the future. None of these actions feel catastrophic, but together they reshape momentum. When activity slows across enough layers at once, recovery becomes harder, not easier. The economy loses elasticity. It stops bouncing back and starts settling lower. This is how visible stress zones form, not through shock, but through accumulation that drains resilience over months. People sense it before they can name it, feeling cautious without knowing why. Conversations shift from growth to survival. Plans narrow. Risk tolerance evaporates. By the time statistics confirm what intuition already knew, the adjustment has progressed too far to reverse quickly, leaving only adaptation as the rational response. At that point, waiting becomes costly, and action, even imperfect, carries less risk than staying still while conditions quietly deteriorate around unprepared communities everywhere. Watching this stage is uncomfortable because it removes comforting narratives. These states show that collapse doesn't require panic. It requires imbalance and time. When cushions fail, adjustment becomes compulsory. People don't argue with markets forever. They respond when costs exceed income and hope stops bridging the gap. This is where denial usually breaks. Not with chaos, but with acceptance. Households change plans, investors change models, governments change language. By the time this shift is obvious, prices and opportunities have already moved. Understanding this phase doesn't create fear, it creates clarity. And clarity is what separates those who react late from those who position early, while the rest wait for reassurance that never comes. Subscribe and hit the bell, because from here on, the stress doesn't hide anymore. Number 4 is Florida, and this is where scale stops protecting anyone. Florida's boom was powered by migration, construction, and confidence, but beneath that growth sat a fragile foundation. Insurance didn't just rise, it fractured. Premiums surged beyond incomes, carriers exited, and coverage became unreliable. When protection fails, ownership becomes risk, not reward. Housing doesn't need falling prices to break. It only needs carrying costs to exceed tolerance. As migration slows and inventory swells, Florida's growth myth gives way to arithmetic, and arithmetic always collects. Then comes California, number 3. The state that taught America to equate size with safety. California isn't facing a cycle, it's facing accumulated obligation. Housing costs detached from wages years ago, but growth narratives mask the strain. Now tax receipts wobble, population drains away, and budget gaps widen. Pensions loom like shadows behind every policy choice. When a state must choose between raising taxes or cutting services, both paths accelerate exit. Wealth concentrates, but liquidity vanishes. The market doesn't collapse loudly. It erodes as buyers step back and sellers chase yesterday's value. California's housing weakness isn't about desirability, it's about math. When median incomes can't support median homes, demand survives only through leverage and belief. Once belief fades, leverage snaps. Commercial vacancies rise, residential listings linger, and optimism loses its grip. Size delays recognition, not consequence. The larger the system, the more inertia hides imbalance until adjustment arrives everywhere at once. Number 2 is Illinois, and here the problem is unmistakably structural. Illinois doesn't bend with cycles. It grinds under obligations. Pension promises dwarf revenue growth. Taxes rise while services thin. Each increase pushes residents out, shrinking the base that must support what remains. Housing reflects this quietly. Prices hold longer than expected, but foreclosures persist. Buyers hesitate because Future costs feel unknowable. Stability becomes an illusion maintained by those who haven't yet left. What ties Florida, California, and Illinois together is convergence. Insurance failure meets housing strain. Pension weight meets tax flight. Industry concentration meets population loss. These forces don't operate independently, they compound. When momentum fades, the system doesn't pause, it reprices. Growth stories lose credibility, and credibility is what sustains markets in transition. This is the moment where status myths collapse. Big economies aren't safer, they're heavier. When they turn with force. Capital becomes cautious. Lenders tighten, employers stall. Households feel pressure without headlines explaining why. By the time narratives catch up, outcomes are already locked. Understanding these states isn't about fear, it's about orientation. Cycles don't reward loyalty to old stories. They reward clarity. When structural stress replaces cyclical noise, waiting becomes expensive. These states sit at the epicenter because everything converges here first. When the core weakens, signals ripple outward, faster than optimism can follow. History shows this pattern repeating whenever systems outrun sustainability. Growth masks imbalance, then imbalance dictates terms. People assume resilience equals permanence, until obligations exceed capacity. Markets don't ask permission to adjust. They respond to constraints. Recognizing that truth early isn't pessimism, it's leverage. It allows you to plan, to preserve options, and to avoid emotional decisions when pressure peaks. That awareness turns uncertainty into strategy, and strategy into calm, deliberate action before crises remove flexibility and force reactive choices under intense stress. Subscribe and hit the bell, because the epicenter always matters most. Number 1 is New Jersey, and this is where the story stops being political and becomes purely mathematical. For years, residents were told higher taxes bought stability, that proximity to power insulated risk, that wealth meant safety. What's unfolding now breaks that promise quietly. New Jersey is not running out of optimism, it is running out of margin. This state sits closest to the edge because its buffers are gone. Operating reserves are razor-thin, measured in days rather than months. When revenue slips, there is no cushion to absorb the shock. Pension obligations tower over the budget like an unpayable debt clock, demanding contributions faster than growth can supply. Each year, more money is committed to promises made long ago, leaving less for schools, infrastructure, or relief when downturns arrive. Housing reflects this strain immediately. Property taxes are among the highest in the country, insurance keeps climbing, and mortgage rates no longer forgive stretched buyers. Homes don't need to crash in price to become unaffordable. They only need the monthly math to stop working. As foreclosures rise and listings linger, confidence erodes without panic, just quiet resignation. What makes New Jersey dangerous isn't mismanagement alone, it's convergence. High taxes push residents out. Out-migration shrinks the tax base. A smaller base must then support even larger obligations. That feedback loop tightens relentlessly. Raising taxes accelerates exit. Cutting services reduces quality of life. Borrowing delays pain but deepens it. Every option narrows the future instead of expanding it. This is where expectations shatter. New Jersey was supposed to be resilient. Educated workforce, high incomes, diversified economy. But resilience without flexibility is illusion. When reserves vanish and obligations dominate, the system loses its ability to adapt. The market senses this before politicians admit it. Capital grows cautious. Lenders tighten. Households hesitate. This is not an isolated failure, it's a preview. New Jersey isn't collapsing because it's unique. It's collapsing because it reached the mathematical limit first. Other states carry similar burdens, just with slightly more time. That's what makes this moment existential. When the first domino tips, belief changes everywhere. If you're watching this, your perspective shifts here. You stop seeing collapse as drama and start seeing it as arithmetic. You recognize how quickly safety narratives dissolve when numbers stop cooperating. That awareness isn't fear, it's preparation. It reminds you that no state is exempt when promises exceed capacity. Understanding this early preserves choices, leverage, and calm, while others wait for permission from headlines to act. Subscribe and hit the bell, because this isn't theoretical anymore. Zooming out, what you've just watched isn't 12 separate stories but one pattern repeating at different speeds across different states. Because collapse doesn't announce itself. It aligns pressures until adjustment becomes unavoidable. And once you see that, noise fades and structure comes into focus, which is why this checklist exists to replace fear with clarity. Start with housing prices versus wages, because when prices outrun incomes, demand doesn't disappear, it stretches until participation quietly vanishes. Then look at pension obligations and total debt. Since promises made in good years don't shrink in downturns and eventually erase. Flexibility. Examine dependence on federal funding, because support feels stable until policy shifts turn distant decisions into immediate local shocks. Assess industry concentration, because states built around one engine rise fast and fall faster when momentum slows. Factor in insurance and climate exposure, as rising premiums act like hidden rate hikes that disqualify buyers without drama. And finally, watch population movement, because it doesn't take mass exits, only fewer arrivals for excess supply to form and prices to adjust mechanically. This isn't predictive theater, it's a diagnostic lens you can apply anywhere, and when multiple signals align, outcomes narrow regardless of narratives, restoring agency instead of panic. So you move deliberately while others argue headlines. Drop a comment with the state you think cracks next, because debate sharpens awareness, and subscribe and hit the bell. I'll track the next break before it's obvious.